If you were looking at the global markets today, March 20th, 2026, the numbers on your screen are likely telling you a story of just, well, systemic panic.
Yeah, absolute panic across the board.
Right. You are seeing Brent crude oil violently swinging toward, what, $92 a barrel? You're seeing the S&P 500 logging consecutive weekly declines.
It's a bloodbath in the legacy markets.
It really is. I mean, you're reading reports of 8 million barrels of daily oil production simply taken offline, just shutting down global supply chains overnight. The macroeconomic weather vane is pointing directly toward a severe recessionary
A
storm.
massive storm, yes.
But, and this is the crazy part, if you look over at the Hong Kong equity markets, specifically the IPO data for the first quarter, you see something that mathematically, should not be happening.
It completely defies logic.
Exactly. You see US $11.64 billion raised, a 385% year-over-year increase.
Which is just a staggering number.
It's huge. A massive historic boom in capital deployment happening at the exact moment the rest of the world is, like, gripping the steering wheel in terror.
Yeah, it forces a complete reevaluation of how capital behaves under stress. Because the assumption has always been that geopolitical shock creates a universal contraction, right?
Well, everyone runs for the hills.
Exactly. Investors pull their chips off the table. They retreat to safe havens like gold or, sovereign bonds. And high growth, speculative capital completely dries up.
It just vanishes.
But the data we are parsing today proves that capital isn't retreating. It's aggressively relocating and concentrating into very specific future-facing architectures.
Okay, let's unpack this. We are so glad you're joining us for this deep dive. Today, we are taking a massive stack of senior market intelligence.
It's a really dense stack today.
Yeah, real-time HKEX exchange data, comprehensive geopolitical strategic briefings, the latest IEA oil market report, and global financial news. And we are tearing it down to the studs.
We really need to get to the bottom of this.
We are going to decode this massive structural paradox for you. We'll explore how biotechnology, next-generation tech, and cryptocurrency are not just, surviving this global storm, but are actively re-engineering the mechanics of the global economy.
Before we begin unpacking the mechanics of these markets, there is a critical baseline we have to establish regarding the geopolitical context of our sources.
Absolutely. We have to do this. The data we are analyzing today is heavily influenced by highly politically charged events, specifically the ongoing and, frankly, severe war in the Middle East involving Israel, Iran, and the United States.
Right. It's the elephant in the room.
It is. So we need to state clearly and unequivocally to you, the listener, that neither of us takes any side in this conflict. We do not endorse any political viewpoint. We do not support any military action, and we are not making ideological judgments.
We are just looking at the numbers.
Strictly and impartially analytical. We are reporting the factual content provided in the source material solely to understand its profound objective impact on global financial markets, supply chains, and, the flow of institutional capital.
Because the physical reality of that conflict is exactly what is driving the macroeconomic fear we are seeing. To understand why the Hong Kong IPO boom is so anomalous, we have to look closely at the sheer scale of the disruption detailed in the IEA oil market report.
It's not just a blip.
No, this isn't just a minor supply chain hiccup. We're looking at the largest structural disruption to energy flows in modern history.
So let's look at the physical choke points. The sources highlight that crude and oil product flows through the Strait of Hormuz have effectively collapsed.
Which is terrifying for the global economy.
Right. Prior to this escalation, that single strait was handling roughly 20 million barrels per day. I mean, that is the transit route for nearly 20% of the entire global oil trade.
And the mechanical problem with the Strait of Hormuz is that it lacks viable, large-scale alternative routes. You can't just easily pipe that volume of oil overland.
You just can't physically do it.
Exactly. Because those tanker routes are effectively paralyzed, we are seeing a cascading mechanical failure in production. Gulf countries are not necessarily cutting production strictly as a geopolitical tactic. They're literally physically running out of storage capacity.
Wow.
The tanks are full, and there are no ships to take the product away.
That's incredible, and the numbers confirm that. The sources indicate at least 8 million barrels per day of crude production is curtailed, alongside another 2 million barrels of condensates and natural gas liquid.
Yeah, massive amount of energy just sitting there.
But it's the downstream effects that really start to strangle the global economy, right? I mean, it's not just unrefined crude sitting in tanks.
No, the downstream effects are where the recessionary pressures really multiply. Over 3 million barrels per day of refining capacity in the region is shut down. Look at the petrochemical sector. Gulf producers typically export roughly 3.3 million barrels per day of refined products and 1.5 million of LPG. The intelligence briefings note that petrochemical plants are now being forced to curb the production of polymers because they just cannot source the necessary LPG and naphtha.
And polymers are in everything.
They are the building blocks for almost everything manufactured globally, from medical plastics to automotive components.
So if you are an institutional investor watching this, you are seeing the physical inputs of the global economy just dry up, and the price action totally reflects that underlying panic.
Absolutely.
Brent crude futures initially spiked to almost $120 a barrel. It settled around $92 a barrel by this date in March 2026, up $20 for the month. But Saudi officials are warning that if this situation stretches into late April, we could see oil surge toward $180 a barrel.
Which is the threshold for massive demand destruction.
Right.
At $180 a barrel, the cost of moving goods, manufacturing basic commodities, and maintaining baseline economic activity becomes so high that consumption simply collapses.
That just breaks the system.
It does. JP Morgan explicitly cited this risk when they lowered their S&P 500 target to 7,200. That is the macro environment. It is a highly pressurized, fragile system just bracing for impact.
Which brings us back to the central paradox of this deep dive. If the macro environment is suffocating under energy costs and geopolitical fracturing, how do we explain the micro-reality in Hong Kong?
It's the golden question.
Right. We are looking at a first quarter where the Hong Kong IPO market pulled in US $11.64 billion across 14 transactions and 13 secondary listings. It's like a bustling, highly profitable indoor farmers market operating while a massive hurricane rages outside.
I love that analogy.
Yeah.
And the contrast is sharpest when you zoom in on a single day, Friday, March 20th, 2026.
Okay, what happened that Friday?
On the exact same day that global indices were bleeding, 5 mainland Chinese companies launched their Hong Kong share sales, aiming to pull in a combined HK $5.3 billion.
Wow. And these are not traditional legacy industrial companies. The roster is incredibly specific. You've got Epiworld International, Guangdong Huayan Robotics, Shandong Extreme Vision Technology, Hangzhou Diagens Biotechnology, and Beijing Tong Rentang Healthcare Investment.
The sector composition is vital. But before we analyze what these companies actually build, there is a structural, legal detail in their filings that tells a massive story about domestic Chinese capital flows.
Oh, the incorporation structure.
Exactly. The financial reports explicitly note that all 5 of these companies are incorporated directly in China. They are entirely bypassing the traditional red chip structure.
Let's pause and actually look at the mechanics of that, because the red chip structure has been the backbone of Chinese overseas listings for decades.
It really has.
If you are listening to this and you've ever bought shares in a major Chinese tech giant on a U.S. exchange, you likely didn't actually buy shares in the Chinese operating company, did you?
Usually no. You bought shares in an offshore holding company, most often incorporated in the Cayman Islands or Bermuda.
Right.
That offshore entity uses a series of complex legal contracts. They're often called variable interest entities, or VIEs, and they use these to mimic ownership of the domestic Chinese assets, which are often in sectors where foreign direct investment is heavily restricted by Beijing.
It has always felt like a massive legal workaround to me, like a way to access global capital without technically violating domestic foreign ownership laws.
It was a workaround, and it came with inherent structural risks for global investors,
Yeah.
primarily regarding the enforceability of those contracts if Beijing ever decided to invalidate them.
Yeah, that was always the fear.
But it was the standard playbook. What we are seeing on March 20th is a complete departure from that playbook. 5 highly strategic companies, raising over 5 billion Hong Kong dollars, are simply listing as mainland incorporated entities on the HKEX.
So what does the abandonment of the offshore structure signal to the market? Why is it happening now amidst all this macro chaos?
It signals a profound regulatory alignment between Beijing and Hong Kong, and a surge in domestic corporate confidence. These founders and their domestic backers no longer feel the need to seek the perceived legal shelter of a Cayman Islands entity.
They're just staying home, basically.
Yeah. By listing directly as mainland H shares, they strip away a massive layer of offshore legal complexity and audit friction. More importantly, it solidifies the Hong Kong Stock Exchange as the ultimate, undisputed conduit for China's strategic industries to access global institutional capital.
Wow.
It's a statement that Hong Kong's financial infrastructure is fully integrated and trusted by the mainland's most critical tech sectors.
But I struggle with the underlying psychology of the capital allocators here. Because on that exact same Friday, March 20th, the benchmark Hang Seng Index opened down 163 points. The secondary tech index was down nearly 2%.
The broader market was definitely hurting.
Right. The traders buying and selling existing shares are clearly reacting to the macro storm. They're selling. So how are institutional investors simultaneously pouring billions into these new IPOs? How do you have a bleeding index and a booming IPO pipeline in the exact same building?
It requires separating the timeline of the capital. The Hang Seng Index, dropping 163 points, represents the secondary market.
Okay.
Those are traders and algorithms reacting to real-time, daily liquidity conditions. They are reacting to the overnight news out of the Middle East, the latest inflation print, the daily cost of capital. That capital is highly reactive and highly liquid.
So the secondary market is basically trapped in present tense.
Yes, beautifully put. The primary market, the IPO market, operates in the future tense. When a massive sovereign wealth fund or a Tier 1 venture capital firm decides to anchor the IPO of a robotics company like Guangdong Huayan, they are not trading on what the price of Brent crude will be next Tuesday.
They don't care about next Tuesday.
Right. They are making a deeply researched, multi-year structural bet on the automation of the global supply chain. They are locking their capital up for a significantly longer horizon.
That makes sense conceptually, but it still requires the Hong Kong Stock Exchange to provide a highly specific environment to attract that long horizon capital. The exchange isn't just passively acting as a toll booth here, are they?
Far from it.
The sources detail a very aggressive regulatory shift that the HKEX is pushing through right now to actively engineer this boom. To understand why companies are flocking to this indoor market, we have to look at the new rules of the building.
We are talking about corporate governance, specifically the structural reforms around dual-class shares. If you want to understand why the world's most innovative companies choose one exchange over another, you have to look at the voting rights.
Let's get into that. The sources note that the Hong Kong Stock Exchange is currently proposing to lower the market value thresholds for companies seeking dual-class share structures. Let's dig into the mechanics of this, because it essentially dictates who actually wields power in the modern tech economy.
Let's start with the baseline. The traditional foundation of public equity markets has always been the one share, one vote principle. It is democratic capital.
Makes sense.
If an institutional pension fund provides 60% of the capital to a company, they receive 60% of the shares, and therefore 60% of the voting power to elect the board of directors and influence corporate strategy.
But the reality of building a next-generation tech company, whether it's an AI foundation model or an autonomous robotics platform, is that it requires a staggering amount of upfront capital before it ever generates a single dollar of profit.
Which forces founders to undergo constant dilution. A founder starts with 100% ownership in their garage. They raise a seed round and sell 20%. They raise a Series A and sell another 20%.
Right. It just keeps shrinking.
By the time they go through Series B, Series C, and eventually file for an IPO, that visionary founder might mathematically own only 12% or 15% of the total equity in their own company.
And in a one-share, one-vote system, if you only own 15% of the voting power, the institutional investors who own the other 85% can simply vote to fire you if they don't like your strategy or if you miss an earnings target.
Precisely. And tech founders are notoriously protective of their long-term vision. They do not want to be beholden to the quarter-to-quarter profit demands of Wall Street asset managers. So the legal architecture of the dual-class share structure was popularized.
So how does the math of a dual-class system actually function to protect the founder, like practically speaking?
The company creates two distinct classes of stock. Class A shares are sold to the public and carry one vote per share. Class B shares are held exclusively by the founders and early insiders, and they carry super voting rights, often 10 votes or even 20 votes per share.
Oh, wow. So a founder could hold only 10% of the actual economic value of the company, but because their specific shares carry 10x voting power, they effectively hold like 55% of the total voting authority.
Yes, exactly.
They retain absolute dictatorial control over the company's direction while using billions of dollars of public money to fund it.
And historically, major global exchanges, including Hong Kong, absolutely despised this structure. The HKEX explicitly banned it for decades.
Really? Banned it completely.
Completely. Their argument, which is structurally sound, is that it severely degrades shareholder protection. If public investors are taking the vast majority of the financial risk, they should have the legal power to intervene if management becomes reckless or incompetent.
That's a fair point. But the HKEX eventually had to cave, didn't they? The sources reference the historical context here.
They did. The watershed moment was 2014. Alibaba was preparing for what would be one of the largest IPOs in history. They wanted to list in Hong Kong, but Jack Ma and his management team demanded a corporate structure that allowed them to retain control.
And Hong Kong said no.
The HKEX refused to bend their one share, one vote rule. So Alibaba simply took their historic IPO to the New York Stock Exchange, which permitted dual-class shares.
Ouch. That had to be a massive shock to the system for Hong Kong regulators. Just watching a crown jewel of the domestic tech ecosystem list 8,000 miles away over a corporate governance dispute.
It forced a total reevaluation. By 2018, Hong Kong reformed its listing rules to permit dual-class shares, officially known as weighted voting rights or WVRs, specifically to attract innovative, high-growth tech companies.
Okay, so they adapted.
Yes, but they initially set the market capitalization thresholds incredibly high. They wanted to ensure that only massive, proven unicorns with significant track records could utilize the structure as a way to mitigate the risk to retail investors.
And now, looking at the March 2026 data from our sources, the HKEX is aggressively pushing to lower those exact thresholds. They are widening the gates.
The strategic intent is clear. If we connect this to the bigger picture, the exchange recognizes that the next wave of vital technology, advanced AI, deep tech hardware, next-generation biotech, is highly capital-intensive from day one.
Right.
If Hong Kong wants to capture the IPOs of companies valued at $1 or $2 billion, rather than just the $10 billion giants, they have to offer those founders the control they demand. It is a calculated concession of corporate governance in exchange for capital capture.
I think we have to look at this critically, though. Is lowering the threshold an indicator of immense strength, showing that Hong Kong is agile and adapting to the needs of modern innovation? Or is it an indicator of desperation?
That's a very valid question.
Because the global IPO market has been sluggish outside of this specific HKEX boom, are they intentionally degrading the protections for everyday shareholders just to keep the listing fees rolling in and maintain their top-tier global ranking?
That tension is exactly what makes financial regulation so complex. It is a deliberate trade-off. The corporate governance advocates argue that this is a race to the bottom, where public markets are essentially becoming unregulated venture capital pools, where public investors shoulder all the risk with zero oversight authority.
Which is scary for the average investor.
Absolutely. But from the perspective of the exchange, if you do not adapt, capital simply roots around you. Capital flows to the path of least resistance and maximum founder alignment.
And whatever your philosophical stance on the governance, the empirical data shows the strategy is working. The capital is flowing into Hong Kong. But to truly understand this paradox, we have to stop looking at the rules of the exchange and start looking at the actual companies going public.
Yes, the companies themselves are the real story.
When you parse the specific names from the Futu News and RTHK reports, you realize these aren't just isolated tech startups. They represent a massive interconnected web of next-generation infrastructure.
If you aggregate the specific sectors highlighted in the March 20th trading data, a hidden nexus emerges. The market is not just funding disparate software ideas. It is aggressively financing a closed-loop physical supercycle driven by artificial intelligence.
Here's where it gets really interesting. We tend to think of artificial intelligence as an ethereal, software-bound concept. We think of large language models, code generation, chatbots. It lives in the cloud, which implies it has no physical footprint.
Right. People forget about the hardware.
But the capital flows on the HKEX are telling a story about massive, heavy physical infrastructure.
Let's trace the physical demands of an AI ecosystem, starting from the application layer and working our way down to the atomic level. Look at Guangdong Huayan Robotics, which priced its IPO to raise HK $1.37 billion. Their focus is on collaborative robots used in industrial automation.
Okay, so how does a collaborative robot, a cobot, differ mechanically from the massive robotic arms we've seen in automotive manufacturing plants for the last 40 years?
A traditional industrial robot is effectively blind and deaf. It executes a pre-programmed spatial movement with immense speed and force.
It just swings its arm no matter what.
Exactly. Because it cannot perceive its environment, It has to be locked inside a heavy steel cage. If a human walks into its path, the robot will simply crush them without stopping.
Good Lord. So a collaborative robot is designed to operate outside the cage, right alongside human workers.
Yes, and to do that safely, it requires an immense layer of real-time intelligence. It requires force torque sensors at every joint to detect the slightest unexpected physical resistance. More importantly, it requires deep computer vision to constantly map and predict the movement of humans and objects around it.
Which perfectly aligns with the other major IPO on the list, Shandong Extreme Vision Technology, which is explicitly an AI computer vision firm.
You see the connection. The capital is funding the physical body, the cobot from Huayan, and simultaneously funding the visual cortex, the AI vision from Extreme Vision. But those models require staggering amounts of real-time data processing to function.
Right, you can have lag.
You cannot have latency when a robot is operating inches from a human being.
Which means all that data has to be processed in massive, hyperscale data centers. And this is where the secondary market data from the sources becomes incredibly revealing. The Future News Midday Review explicitly highlights a massive surge in optical communications stocks.
That's the nervous system right there.
FFIT H-on-Teng was up over 13%, and Yangtze optical fiber and cable climbed nearly 10% in a single day.
Why does AI demand optical fiber? Because inside a hyperscale data center, training a multi-trillion parameter AI model requires thousands of GPUs to constantly communicate with each other, sharing parameter updates in fractions of a millisecond.
And old-school copper wire can't handle that.
Traditional copper wire transmits data using electrons. Copper has inherent physical limitations regarding bandwidth and heat over distance.
So you have to switch from moving electrons to moving photons.
Yes. Optical cables use pulses of light. They offer exponentially higher bandwidth with near-zero latency and significantly less heat generation. The surge in companies like Yangtze Optical reflects the market realizing that the internal nervous system of the AI revolution has to be entirely rebuilt using advanced photonics.
Okay, so we have the robotic application, the computer vision, the data center, and the optical cables connecting it all. But running thousands of GPUs and transmitting light across millions of miles of fiber requires an astronomical amount of raw power.
The energy cost of AI is perhaps the largest hidden variable in the modern economy. A single next-generation AI server rack can consume an order of magnitude more power than a traditional cloud server rack.
Wow, an order of magnitude.
The existing electrical grid simply wasn't designed for massive, localized, high-density power drives that run 24 hours a day at maximum capacity.
Which brings us to the energy infrastructure data points in our sources. We see CATL, the massive lithium battery manufacturer, jumping over 4%. Morgan Stanley put out a highly specific note explicitly stating that CATL's energy storage shipments are being directly boosted by AI demand.
Historically, when we talked about CATL, we were talking about electric vehicle battery.
Yeah, EVs.
But the institutional capital is realizing that hyperscale data centers must have massive on-site battery storage systems. These battery farms act as a buffer. They draw power from the grid during off-peak hours or draw from local renewable sources like solar and then deploy that stored power continuously to ensure the data center never experiences a voltage drop or a grid failure.
And the sources also note that Tesla is in talks for a $2.9 billion solar equipment deal with Chinese suppliers like Suzhou Maxwell Technologies. The ecosystem is basically securing its own independent power generation.
But generating and storing that massive amount of power introduces a critical bottleneck at the material science level.
Oh, how so?
When you are managing high voltage, high current power flows, whether from a massive solar array into a commercial battery farm, or from that battery farm into a hyperscale GPU cluster, you have to convert and manage that electricity using power semiconductors.
And traditional silicon chips struggle with that level of power, right?
Standard silicon has a relatively narrow band gap. In solid-state physics, the band gap determines how well a material can conduct or block electricity. When you push massive amounts of high-voltage power through standard silicon, it hits a thermal and electrical ceiling.
It just can't take it.
It generates immense heat, it leaks energy, and eventually the material degrades or fails.
And if the power controllers are generating heat, you have to spend even more power just running the cooling systems in the data center, which defeats the whole purpose.
Exactly. This brings us to the missing link, the largest IPO of the entire March 20th cohort, Epiworld International. They pulled in HK $1.64 billion. And they don't make standard silicon chips. They manufacture silicon carbide epitaxial wafers.
What exactly is silicon carbide, and why is it worth $1.64 billion to the market right now?
Silicon carbide, or SiC, is a compound of silicon and carbon. It is a wide bandgap semiconductor. Because of its specific crystalline structure, electrons can move through it much faster, and it can withstand significantly higher electrical field strengths than pure silicon.
What does that mean in practical application for an AI data center or an electric vehicle?
It means a silicon carbide power converter can operate at much higher voltages, process higher frequencies, and withstand vastly higher temperatures without losing efficiency. It allows the power management components to be smaller, lighter, and crucially, they run much cooler.
So they are basically the heat shields.
Epiworld is manufacturing the foundational atomic material that allows the entire high-voltage AI and energy ecosystem to function without literally melting down.
When you lay out the mechanics of this, it is breathtaking in its interconnectedness. We are watching the modern equivalent of the gold rush. But instead of buying mining claims, investors are buying the companies that make the pickaxes, like the silicon carbide, the railroads, like the optical cables, and the food for the miners, the energy storage.
It is a fully integrated thermodynamic loop, and the institutional capital flowing into the HKEX is systematically funding every single node in that loop. They're funding the physics of the future economy.
That covers the external infrastructure, the hardware, the energy, the automation. But while silicon and energy are reshaping our external world, another massive capital shift is happening to reshape our internal world. I'm talking about the surge in the biotech sector.
The biotech landscape on the HKEX has evolved significantly. Hong Kong introduced specific listing rules, Chapter 18A, years ago to allow pre-revenue biotech companies to list.
Right.
That laid the groundwork for a highly mature, highly aggressive biotech ecosystem.
And the data from March 20th shows exactly how aggressive the risk appetite is in this sector. We have to talk about Genfleet-B. According to the Futu News midday review, Genfleet stock surged over 14% in a single half-day trading session.
A 14% intraday jump is a massive, highly volatile move. In traditional sectors, you only see that magnitude of price action following a major surprise earnings beat, a systemic regulatory change, or an acquisition announcement.
But Genfleet didn't jump because they have a drug dominating the market. The sources note they surged on the promise of preclinical research results. They are set to announce data for 3 innovative large and small molecule products at the upcoming 2026 American Association for Cancer Research annual meeting.
The operative word here is preclinical, and we need to define exactly what that means in the life cycle of drug development to understand the risk the market is taking.
Right, because the drug discovery pipeline is notoriously brutal.
It is arguably the most complex and failure-prone industrial process on Earth. Before a drug can ever be sold, it goes through a rigid pipeline. Discovery, where the molecule is identified, then the preclinical phase.
So before humans are involved.
Yes. Preclinical means the drug has absolutely never been tested on a human being. It is strictly being evaluated in vitro, in test tubes and cell cultures, or in vivo using animal models, typically mice or non-human primates.
The goal of the preclinical phase is just to prove that the molecule isn't universally toxic and that it hits the intended biological target in an animal, right?
Yes. It establishes foundational safety and biological activity. If it passes, it moves to Phase 1 clinical trials, which tests safety in a small group of healthy human volunteers. Phase 2 tests efficacy in a larger group of patients who actually have the disease.
And then phase 3 is the big one.
Phase 3 is a massive, expensive, large-scale trial to confirm efficacy and monitor adverse reactions against standard treatments.
And the attrition rate across that pipeline is staggering. The vast majority of molecules that look like miracle cures in a mouse model fail completely when introduced to the immense complexity of human biology. They either prove too toxic or they simply do not work.
So when we see Genfleet-B surge 14% based entirely on an upcoming presentation of preclinical laboratory stage data, it reveals a fascinating shift in how capital is pricing scientific potential.
They're jumping the gun, essentially.
The market is not waiting for a commercialized product. It is aggressively pulling value forward, pricing in the statistical probability of molecular success at its absolute earliest, riskiest stage.
And the sources mentioned they are presenting data on both large and small molecule products. What is the fundamental difference there from an investment perspective?
It dictates the manufacturing complexity and the biological mechanism. A small molecule is exactly what it sounds like, a chemical compound with a low molecular weight. Think of everyday drugs like aspirin or statins.
What's up in your medicine cabinet?
Right. Because they are tiny, they can easily pass through cell membranes to reach intracellular targets. They are synthesized through predictable chemical reactions, meaning they are relatively cheap to manufacture at scale once approved.
And large molecules.
Large molecules, often called biologics, are highly complex, massive structures like monoclonal antibodies or therapeutic proteins. They're thousands of times larger than small molecules.
So they can't get into the cells as easily.
They typically cannot enter a cell. Instead, they bind to specific receptors on the outside of the cell surface. They're incredibly difficult to manufacture because they have to be produced within living cells or organisms in highly controlled bioreactors.
So Genfleet is targeting both the intricate intracellular targets with small molecules and the complex extracellular pathways with biologics. But why is the market so suddenly willing to underwrite this level of early-stage preclinical risk? What has changed?
The introduction of artificial intelligence into molecular biology.
Yeah.
Just as we saw AI driving the hardware supercycle, we are seeing AI fundamentally alter the math of drug discovery.
You're referring to AI models that can predict protein folding and simulate molecular binding.
Exactly. Historically, finding a small molecule that fits perfectly into a disease-causing protein was a process of physical trial and error. High-throughput screening of millions of compounds in a lab. It took years.
Very slow process.
Now, deep learning models can analyze the three-dimensional atomic structure of a target protein and computationally design a novel molecule that will bind to it with high affinity.
It compresses the discovery timeline from years down to months or even weeks.
And crucially, it theoretically increases the probability of success. If an AI model has computationally verified the binding mechanics before the molecule ever enters a mouse model, the institutional capital believes the preclinical data is inherently more robust.
So they trust the algorithm.
That is why they are willing to bid the stock up 14%. They believe the AI-driven pipeline has de-risked the biology.
This requires a highly specific type of investor. If you are managing a portfolio, you can't just look at a traditional price-to-earnings ratio for a preclinical biotech firm because there are no earnings, there is no revenue.
The HKEX has successfully cultivated a highly sophisticated, high IQ capital base, specifically for Chapter 18A biotech listings. These are specialized institutional funds that employ PhDs in molecular biology, oncology, and computational chemistry.
These aren't just regular stockbrokers.
Not at all. They are actively reading the abstract for Genfleet's AACR presentation, analyzing the mechanism of action, reviewing the specific binding affinity data of the small molecules, and running complex Monte Carlo simulations to calculate the probability of the drug passing phase 2 trials 3 years from now.
It's an incredible display of scientific optimism. But I have to ask you to consider this. Looking at the macro picture we started with, the global economy is terrified of an oil shock, inflation, and a recession. In that environment, traditional growth companies like software, consumer discretionary, they look highly vulnerable.
Very vulnerable.
Is it possible that this surge in early-stage biotech isn't driven entirely by a deep belief in the science, but rather by high-stakes financial speculation? When a stock jumps 14% before human trials even begin, are we seeing unparalleled scientific optimism, or is this just capital desperately seeking an uncorrelated asset class?
It is almost certainly a combination of both. In a volatile macro environment driven by geopolitical shock, institutional capital looks for assets with binary, idiosyncratic return profiles.
Meaning the outcome of the investment has absolutely nothing to do with the broader economy.
Correct. If Genfleet's large molecule successfully targets a novel cancer pathway and clears clinical trials, the value of that asset will be astronomical, regardless of whether Brent crude oil is trading at $90 or $180 a barrel.
Because people always need medicine.
The biological efficacy of the molecule is completely insulated from the Strait of Hormuz. For a portfolio manager trying to hedge against global macro chaos, that uncorrelated, albeit highly risky, upside is incredibly attractive.
Speaking of high-stakes financial speculation and assets that were designed to be completely decoupled from traditional macroeconomic structures, there is one more asset class moving from the fringes into the very heart of the traditional financial establishment.
You are looking at the integration of cryptocurrency onto the primary exchange interface.
Exactly. If you open the primary HKEX market overview provided in our sources, right there alongside the foundational pillars of Asian finance, the Hang Seng Index, the China Enterprises Index, the Tech Index, you see live official data feeds for digital assets.
It's quite a sight.
We are looking at the HKEX Bitcoin Reference Index, hovering around 70,631, up slightly for the day, and right below it, the HKEX Ether Reference Index sitting around 2,143.
What's fascinating here is that it is presented with complete normalization. It sits right next to the HSI Volatility Index, treated with the exact same weight and legitimacy as the most established financial benchmarks in the world.
To understand why this is such a profound shift, we have to dissect what a reference index actually is mechanically. People have been trading Bitcoin for over 15 years. There are thousands of crypto exchanges globally. Why does the launch of an official HKEX index matter so much?
Because traditional institutional finance operates on an entirely different regulatory infrastructure than retail crypto traders. We are talking about sovereign wealth funds, highly regulated pension funds, conservative family offices, and major asset managers.
The big money.
They operate under strict fiduciary duties and compliance mandates.
Right. A pension fund managing billions of dollars of retirement money cannot simply open an account on an offshore, unregulated crypto exchange, wire $100 million, and self-custody the digital keys to a Bitcoin wallet.
The legal and counterparty risks are too high. They require institutional-grade plumbing. They require universally agreed-upon, manipulation-resistant pricing mechanisms, rigorous auditing, and regulated custody solutions.
So how does the HKEX reference index solve the pricing problem?
A reference index is not just a single price feed. It is a highly engineered data product. The exchange aggregates real-time price data from multiple, heavily vetted, high-liquidity cryptocurrency spot exchanges.
They pool it all together.
Yes. It applies complex algorithms to filter out anomalies, wash trading, or potential market manipulation to calculate a clean, definitive benchmark price for Bitcoin and Ether at any given second.
Once that clean benchmark is established by a universally trusted, highly regulated entity like the Hong Kong Stock Exchange, what can the traditional financial system build on top of it?
Everything. The index is the foundation. Once you have an official HKEX index, major financial institutions can structure highly regulated derivatives around it. They can issue Bitcoin exchange-traded funds, or EPFs, futures contracts, options, and structured notes.
Which means the wealth manager doesn't actually have to interact with the blockchain at all.
Precisely. The wealth manager never touches a private key. They never worry about a hardware wallet being hacked. They simply sit at their traditional Bloomberg terminal and purchase a financial instrument that strictly tracks the HKEX Bitcoin Reference Index, using the exact same clearinghouse, broker, and compliance framework they use to buy shares of Tencent or HSBC.
It effectively wraps a decentralized, cryptographically native asset in the warm, safe blanket of traditional financial bureaucracy.
It institutionalizes the asset. It bridges the gap between the Wild West of digital tokens and the highly regulated pipes of the global financial system.
Which forces us to confront a massive philosophical contradiction. I mean, if you go back to the original Bitcoin white paper published in 2008 by Satoshi Nakamoto, the entire stated purpose of the architecture was to create a peer-to-peer electronic cash system that completely bypassed centralized financial institutions.
That was the whole point.
It was born out of the 2008 financial crisis as a rejection of major banks and centralized exchanges. Does bringing Bitcoin and Ether into the traditional banking infrastructure of the HKEX defeat the original decentralized purpose of cryptocurrency, or is this the only way it actually achieves mass adoption?
It is the defining ideological battle within the crypto space right now. The cryptographic purists argue forcefully that this institutionalization is a failure of the original vision. They argue that by wrapping Bitcoin and ETFs in traditional exchange indices, you are simply reintroducing the very intermediaries, the brokers, the clearinghouses, the regulators that the blockchain was explicitly designed to eliminate.
You are centralizing a decentralized asset.
And what is the counter-argument for the market pragmatists? The pragmatists argue that this structural integration is the absolute, unavoidable prerequisite for global mass adoption.
You need the big money to grow.
If the ultimate goal of digital assets is to absorb trillions of dollars of legacy global wealth and become a foundational pillar of the monetary system, that wealth is not going to migrate through complex, intimidating self-custody hardware wallets. It demands the security and familiarity of trusted conduits like the HKEX.
So the exchange isn't defeating crypto, it is domesticating it. It is translating the math of the blockchain into the language of institutional capital.
Exactly. The HKEX is building a bridge, and the capital is crossing it.
If we pull all the threads together from the immense amount of senior intelligence we have parsed today, a remarkably cohesive narrative emerges about the true nature of capital in 2026.
We began by defining the macro storm, a global economy under severe historic pressure from a geopolitical conflict, disrupting the world's most critical energy choke point, threatening to paralyze supply chains with $180 oil.
But inside that storm, we found the Hong Kong equity market functioning as a highly pressurized incubator. We saw a regulatory apparatus actively evolving, pushing to lower thresholds for dual-class shares to guarantee founders the control they demand, prioritizing the capture of high-growth innovation over traditional shareholder structures.
And we tracked exactly where that institutional capital is deploying itself. We decoded a massive AI-driven physical supercycle. It is an unbroken chain of investment. AI models necessitating advanced data centers, which require the high-bandwidth photonics of Yangtze Optical.
Smoothed by the massive battery storage of CATL.
Regulated by the extreme temperature silicon carbide of Epiworld, all culminating in the physical, collaborative robotics of Guangdong Huayan.
Simultaneously, we saw capital attacking the fundamental code of human biology, aggressively underwriting preclinical biotech risk with companies like Genfleet, driven by the belief that AI has fundamentally de-risked molecular discovery. And finally, we saw the institutionalization of money itself, with the HKEX standardizing cryptocurrency into regulated reference indices.
It is a profound picture of a financial ecosystem aggressively building the infrastructure of the next decade, completely undeterred by the geopolitical noise of the present.
If you're listening to this, analyzing your own industry or managing your own portfolio, the implications are massive. Think about how the physical energy and hardware demands of AI will reshape supply chains in your sector. Consider how the rapid acceleration of AI-driven molecular biology alters the timeline of healthcare investments, and recognize that digital assets are no longer fringe experiments. They are fully integrated components of the institutional financial stack.
Which leaves us with one final, deeply structural thought to consider before we wrap up.
What is that?
Throughout this deep dive, we have analyzed AI hardware, biotech, and cryptocurrency as three distinct parallel tracks of investment on the exchange. We've seen how AI is currently driving the demand for energy storage and robotics. It is a linear flow of cause and effect. But we must ask what happens when the loop closes.
How do you mean when the loop closes?
What happens when the collaborative robots currently being funded to assemble hardware are integrated with the AI models driving molecular biology? What happens when an AI-driven robot begins autonomously designing the next generation of biotech molecules in a closed-loop laboratory 24 hours a day without human intervention?
Oh, wow. It automates the discovery process entirely.
And what happens when the massive computational engines running those labs aren't just processing data, but are actively writing the smart contracts and executing the decentralized transactions that govern the crypto reference indices we discussed? Right now in the HKEX, we classify robotics, biotech, and crypto under different sector tickers. But driven by the sheer compounding computational force of artificial intelligence, these distinct domains are on a collision course. Very soon, they may merge into a single, indistinguishable engine of human advancement.
The storm outside is raging, but the building inside is being completely rewired, and the walls between the sectors are dissolving. It is a fascinating landscape to navigate, something to mull over until our next deep dive.